dive into the world of finance, where we unravel the concept of mutual funds. Imagine a pot, a rather large one. Now, picture people from all walks of life, each contributing their share of money into this pot. This collective pool of money is what we refer to as a mutual fund. It's not a static pot though, it's dynamic and alive, constantly being invested in a variety of financial instruments like stocks, bonds and others to generate income. And who directs this investment? Well, that's the job of the fund manager, a financial whiz who uses their expertise to decide where and how to invest this pooled money. They constantly monitor the market, making calculated decisions to ensure the fund grows. So, in essence, when you invest in a mutual fund, you're buying a piece of this large, diversified pot. So, mutual funds are essentially a pool of money from various investors, managed by professionals to generate income. Mutual funds come in different flavors, each with its unique characteristics. Just like a wardrobe suits different occasions, mutual funds cater to various investment objectives. First, there are equity funds, primarily invested in stocks. They're the go-to for those seeking capital appreciation over the long haul, but remember, they come with higher risk. Then we have debt funds investing in fixed income securities like bonds. They offer steady returns and are a safer bet for risk-averse investors. Hybrid funds are the best of both worlds, combining equity and debt. They aim to balance risk and return, making them a suitable choice for moderate risk takers. Index funds, on the other hand, mimic a specific market index. They offer broad market exposure and are known for their low-cost structure. Lastly, there are sector and thematic funds, targeting specific industry sectors or themes. They can provide high returns but come with higher risk due to their concentrated nature. Understanding these types helps you align your investment with your financial goals. Now that you know what mutual funds are, let's delve into their benefits and the process of investing. First off, mutual funds provide a fantastic opportunity for diversification. By pooling your money with other investors, you can spread your investments across a broad spectrum of assets, reducing the risk of losing your money if one particular investment doesn't perform well. But it's not just about risk reduction. Mutual funds also offer the advantage of professional management. That's right. When you invest in a mutual fund, you're essentially hiring a team of investment professionals to manage your money. These fund managers use their expertise and experience to make decisions on what to buy or sell, when and in what quantities. This can be a big plus if you're new to investing or simply don't have the time or inclination to manage your investments yourself. Now let's talk about how to invest in mutual funds. The process is relatively straightforward. You start by buying units of a mutual fund. Each unit represents a portion of the fund's portfolio. The price of a unit is based on the net asset value, or NAV, of the fund, which is calculated at the end of each trading day. Before you can buy mutual fund units, however, you'll need to complete a Know Your Customer, or KYC, process. This is a mandatory requirement for all investors and involves providing proof of identity and address, as well as other relevant information. It's designed to prevent financial fraud and ensure that mutual funds are being used for legitimate investment purposes. Once you've completed your KYC process, you can buy mutual fund units directly from the fund company or through a financial intermediary, such as a broker or an online platform. You can choose to make a lump sum investment or set up a systematic investment plan, which allows you to invest a fixed amount at regular intervals. With professional management and a straightforward process, investing in mutual funds can be a smart move. Investing isn't just about the returns, it's also about understanding the costs and risks involved. When it comes to mutual funds, costs are an unavoidable part of the equation. One of the key costs you'll encounter is the expense ratio. This is the annual fee that all funds or ETFs charge their shareholders. It represents the percentage of your investment that goes towards running the fund. While it might seem small, even a 1% expense ratio can add up over time, especially as your investment grows. Another cost to keep in mind is the sales charge or load. This is a commission you pay either when you buy or sell the fund. Some funds are no load, which means they don't have this fee, but they might have other costs like a redemption fee if you sell your shares within a certain period. Now let's talk about returns. We often hear about the past performance of a fund, but it's important to remember that past performance is not indicative of future results. What you can do is look at the fund's consistency over time. While it's impossible to predict the future, A fund with consistent returns may be a safer bet than one with high fluctuations, but where there's return, there's risk. Every type of investment carries some level of risk. For mutual funds, risks can come from market volatility, interest rate changes, or even the failure of a company the fund is invested in. Some funds, like equity funds, can be riskier but offer higher potential returns. Others, like money market funds, are less risky but also have lower returns. The key is to find a balance between risk and return that fits your financial goals and risk tolerance. It's about understanding what you stand to gain and what you could potentially lose. One more thing to note is that costs and returns can be influenced by factors outside the fund itself, like economic conditions and government regulations. So always stay informed and consider seeking advice from a financial advisor if you're unsure. Remember, higher returns often come with higher risks. Balance is key. Mutual funds aren't just about investing, they're also about earning and understanding the tax implications. So, how does one earn from mutual funds? Well, there are two primary ways, through dividends and capital gains. Dividends represent a portion of the profits that a mutual fund earns from its investments, which are then distributed to investors. Capital gains, on the other hand, arise when the fund sells an investment for a higher price than it bought it. These gains are also distributed to investors. Now let's talk about taxes. Remember, Uncle Sam always wants his share. Dividends and capital gains are both taxable, but the rate at which they're taxed can vary. Generally, dividends are taxed at the income tax rate, while capital gains can be taxed at a lower rate if the investment was held for more than a year before it was sold. This is known as long-term capital gains tax. But always consult with a tax professional to understand your individual tax implications. And what about knowing what your fund invests in? This is where portfolio holdings come into play. Portfolio holdings are the individual assets that a fund invests in, such as stocks, bonds, or other securities. Knowing what a fund holds is crucial because it can give you insight into the fund's strategy and risk level. For instance, a fund that invests heavily in technology stocks might have higher growth potential, but also higher risk than a fund that invests in a mix of stocks and bonds. To access information about a fund's holdings, you can check the fund's prospectus or its annual report. These documents provide detailed information about the fund's investments, strategy, and performance. They can also highlight the fund manager's outlook and strategies for the coming year. Knowledge is power. The more you know about your mutual fund investments, the better decisions you can make. So always stay informed, understand your earnings, and keep a keen eye on those tax implications. After all, it's not just about making money, it's about keeping it too. Now let's talk strategy and how to choose the right fund for you. Mutual fund managers usually employ a variety of investment strategies. Some may focus on growth investing, which involves buying stocks of companies they believe will grow significantly in the future. Others may opt for value investing, which involves hunting for undervalued stocks. Then there is the index strategy, where a fund simply mimics a market index, like the S&P 500. Each strategy comes with its own set of potential rewards and risks. Choosing the right mutual fund is an art. It requires understanding your financial goals, risk tolerance, and investment horizon. If you are saving for a long-term goal, like retirement, you might consider equity or balanced funds. These funds invest a significant part of their corpus in equities and have the potential to offer superior returns over the long term. On the other hand, if you're looking for a short-term investment or if you have a low risk tolerance, debt funds could be a better fit. They invest in fixed income securities and are generally considered safer than equity funds. Now let's tackle some frequently asked questions. One question that pops up often is, are mutual funds safe? The answer is, it depends on the type of fund and the market conditions. Mutual funds are subject to market risks, and the value of your investment can go down as well as up. However, they are regulated by financial authorities, making them safer than some other types of investments. Another common question is, can I lose all my money in a mutual fund? While it's unlikely, it is possible, especially if you invest in a very high-risk fund. That's why it's important to diversify your portfolio and match your investments with your risk tolerance. Finally, how soon can I expect returns? The answer to this depends on the type of fund you've chosen. Some funds may offer returns in the short term, while others are designed for long-term growth. Remember, patience is a key virtue in the world of investing. Choosing the right fund is an art. It requires understanding your financial goals, risk tolerance, and investment horizon. To wrap up our discussion, let's look at a real-world example and discuss the regulations governing mutual funds. Diving into the world of mutual funds, it's hard not to stumble upon the name Peter Lynch. Known as one of the most successful mutual fund managers in history, Lynch steered the Fidelity Magellan Fund from 1977 to 1990. During his reign, the fund boasted an average annual return close to 29%, outpacing even the S&P 500. His strategy: invest in what you know and understand. Lynch's success story is a prime example of how knowledge and strategic thinking can lead to remarkable results in mutual fund investing. Now let's pivot to the regulations that govern the mutual fund industry. In many countries, a regulatory body oversees mutual funds to protect investors. In the United States, for instance, the Securities and Exchange Commission enforces laws to prevent fraudulent activities. These regulations ensure that mutual funds operate in a transparent manner, providing investors with the necessary information to make informed decisions. It's crucial to understand that these regulations exist to protect your interests as an investor. Finally, if you're thirsty for more knowledge about mutual funds, there are countless resources out there. For beginners, A Random Walk Down Wall Street by Burton Malkiel is a great start. It offers a comprehensive yet accessible introduction to various types of investments, including mutual funds. Websites like Investopedia and Morningstar provide a wealth of information, from basic definitions to in-depth analyses. For those who prefer a more structured approach, online courses on platforms like Coursera and Udemy cover a range of topics related to mutual funds. Investing in mutual funds requires due diligence, but it can also be rewarding if done right. The journey may seem daunting at first, but with the right resources and a bit of determination, you can navigate the world of mutual funds successfully. Remember, the key is to stay informed and make decisions that align with your financial goals. So, we've covered a lot of ground today on mutual funds. We've unveiled the mystery around what they are, how they operate, and the different types available. We've highlighted the numerous benefits, from diversification to risk reduction, and the professional management that comes with it. We've walked you through the process of investing in mutual funds, the associated costs, returns, and risks. We've touched upon dividends, capital gains, tax implications, and the importance of knowing your fund's portfolio holdings. We've also explored some common investment strategies, how to select the right fund, and address some frequently asked questions. All of this supported by real-world examples and a look into regulatory aspects. Now, it's your turn to take the leap and start your investing journey. Remember, the world of mutual funds has something for everyone, regardless of your investment goals or risk tolerance. Remember, investing is a journey, not a destination. Start your journey today with mutual funds. If you found this information helpful, please subscribe to this channel, like this video, and share it with others who might find it valuable. Your support enables us to keep producing quality content like this, and it means the world to us. If you have any suggestions for future video topics, don't hesitate to leave a comment down below. Thanks for watching, and remember, knowledge is the first step to successful investing. The more you learn, the better equipped you are to navigate the financial markets.